This program is designed to provide general information with regards to the subject matters covered. This information is given with the understanding that neither the hosts, guests, sponsors, or station are engaged in rendering any specific and personal, medical, financial, legal, counseling, professional service, or any advice. You should seek the services of competent professionals before applying or trying any suggested ideas.
Hello, and thank you for tuning in to A Sharp Outlook on K4HD Radio and Talk 4 TV. I am Angela Sharp, your host. Our armchair discussions with industry experts will give you the steps, tools, and information to be successful in business and to prepare you to be your best self. Hello, I'm Angela Sharp, and thank you for joining us at A Sharp Outlook. We're going to have a conversation one-on-one today about something I know you're excited to know about: tax codes, tax code secrets. They're not really secrets. What they are tax codes that, unless you are aware of them, you don't get an opportunity to take advantage of the benefits. So I want to go through some of those benefits that are there and give you some information. But I want you to know this is not complete, because there's probably hundreds and hundreds. In fact, there are hundreds and hundreds and hundreds of tax codes out there. And you're just getting just enough to hopefully, pique your interest to look further or contact expert advice from tax consultants. Tax code benefits and deductions are provisions that allow eligible taxpayers to reduce their taxable income or tax liability. They come in two forms: deductions, which reduce the amount of income tax subject to taxing, and benefits, which include credits and specific exclusions. The differing interests of the tax code versus the IRS is pretty vast. The cost of not acting on those differing interests is huge, and what you don't know can hurt you. That is really important. If you're leaving thousands on the table, seek the advice of professional tax consultants and keep your money in your pocket. It's not free service, but I guarantee you it's definitely going to cost you less than what you're having to pay in taxes. And so you'll want to go and look and seek that advice. The type of business entity you choose could play a significant role in determining your tax liability. So I'm going to try to break this down for you. The differing structures offer varied benefits and implications regarding tax liability. So here are a few to consider. Your business, is it set up as a sole proprietorship? As a sole owner, you report your business income and expenses on your personal tax return using a Schedule C. You pay tax at the individual rate and also pay self-employment taxes to cover for Social Security and Medicare. But if you're a partnership, income losses or credits are passed through directly to the owners, who report them on personal tax returns like the sole proprietor, and the partners also pay self-employment taxes. A corporation, we call it a C Corp. These are separate tax entities from their owners. Corporations kind of suffer from double taxation. First, the corporation pays tax at the corporate level, and then shareholders pay tax on dividends received at the individual level. And then there's the S Corp. The S Corp helps you avoid the double taxation by passing corporate income, losses, and deductions and credits to the shareholders, who include this information on the personal tax returns. Then there's the LLC, the limited liability company. An LLC can choose how it wants to be taxed as a sole proprietorship, a partnership, an S Corp, a C Corp. And this flexibility can be advantageous for tax planning. But changing your tax entity can sometimes be an effective way to minimize tax liability. For instance, converting from a C Corp to an S Corp allows the avoidance of double taxation. However, keep these things in mind. Ownership restriction. S Corps have limitations, such as maximum of 100 shareholders and one class of stock. Evaluate if that aligns with your business strategy. Employment tax saving. In an S Corp entity, only the salary paid to the owner employee is subject to employment tax. The remaining income distributed as dividends is not subject to employment tax. State taxes. While S Corp can provide federal tax benefits, some states do not recognize the S Corp status and can tax businesses as a regular C corporation. So when you're looking at thinking about changing entities, you also need to research what are the state laws? What are the state tax laws? What are you liable for in that particular state? Do they charge state and local taxes? There are some states that do not have state and local taxes that are deducted or have to be paid. But generally, their sales tax is pretty high. But you do save some money because in that particular state, there is no state tax that has to be paid or local tax that has to be paid on your earnings. So that's something to consider. Ownership restrictions. The S Corp has limitations such as I mentioned, 100 shareholders and one class of stock. It just depends on what your strategy is and do you plan on growing and to what size do you plan on growing. The employment tax savings in an S Corp, as I mentioned, is not subject and also the state tax. But there are some other examples of tax deductions and benefits for regular taxpayers. Most people take the standard deduction, and that's a fixed amount that shows up on your form, or you see it in the instructions when you're preparing your tax return. And it does reduce the amount of your gross income, your adjusted gross income. I'll call it AGI. Most taxpayers take the standard deduction rather than itemizing, which is probably simpler and often more advantageous, but you should at least do the analysis and find out exactly what items that you can possibly deduct and then compare the two to find out which one is going to be more advantageous. Keep in mind, you have to be keeping receipts, you have to be logging these because you're going to have to identify each one of those particular deductions and you're going to have receipts for those deductions. But in some cases, there are deductions that you probably are not taking advantage of because you see the amount of the standard deduction and you say, oh, well, this is simple. And even some of your tax preparers are probably doing the same thing. Or if you're using one of those tax preparation software, it'll probably advise you to just take the standard deduction. But if you know that you've had additional expenses throughout the year or something unusual, maybe you invested in a stock and it went, the wrong direction for you, that would be something that you would be able to deduct because that was an investment that you lost on, but you cannot get that benefit if you're taking the standard deduction. And so there are a lot of different deductions. I'm going to try to go through and hit some of the key ones. But that's something to consider. At least compare the two to find out which one is the best direction to go. Itemized deductions, instead of the standard deduction, can itemize certain expenses, and shows up on your tax return. It's a different schedule, and it will reduce your AGI if the total is greater than the standard deduction. Here are some deductions. Retirement contributions, contributions to retirement plan, your 401k, your IRA, are often tax deductible or tax deferred, meaning they reduce your current taxable income. So you're able to deduct that. And then when you do get to retirement, when you generally have a lower tax liability rate than as you are pulling from your 401k, then it becomes a taxable amount. But you may even have very, strong deductible items at that time also. So it will reduce your liability. This could result in significant tax savings and help build your future security. Educator expenses. Eligible educators, teachers, counselors, principals can deduct a limited amount of unreimbursed expenses for classroom supplies, books, and computer equipment. So if you have one of those professions, please keep track of the expenses, because I hear all the time that teachers are having to pay for supplies or pay for different things for their class because there's not enough budget, or it's not part of their curriculum, or they're wanting to take a trip or something like that. They try to raise money, they fall short. You're using your own personal financial. Then you're able to deduct this as if you are itemizing, as I said before. If you are itemizing these expenses, you're able to deduct that. And that can result in significant tax savings. Individuals who use a portion of their home exclusively and regularly for business purposes may be able to deduct associated expenses such as percentage of mortgage, interest, rent, utilities, repairs, different things like that. And it's based on the square footage. It's something that a lot of people have taken advantage for. Specific IRS rules apply to eligibility and the calculation. So you'll want to do some research on that particular deduction to find out, if it will benefit you based on the calculation. Is it really going to be enough? You just can't go in there and say, oh, I'm just going to put this amount down there and think you can deduct. There are rules. You have to know the rules and check that out. Business expenses. Self-employed individuals can deduct a wide range of business expenses, including advertising, utilities, health insurance premiums, business travel, and interest on business loans. You need proper documentation, though. It is required. Charitable contributions. Donations to qualified charitable organizations can be deducted from the taxable income. And during these days and times when there's so many in need, I know many are contributing to nonprofit organizations that are helping to provide food and helping to prevent homelessness, and helping to help those that are disabled, those that are veterans, different things like that. If you're making contributions, you should have some type of schedule that shows how much that you have contributed, how much you have paid. A lot of these organizations that you send to, they will send you a report at the end of the year as to how much your contribution was. But just in case they don't, keep track of that information, and whether it's a check or however you contributed, have those receipts so that you have documentation for that. Medical expense. You may be able to deduct unreimbursed medical and dental expenses. that exceed a certain percentage of your adjusted gross income. This is an itemized deduction, and there's a threshold that you need to meet to make sure that you're able to deduct those expenses. So it doesn't happen automatically. There is a calculation that helps you determine whether or not that is deductible for you. Dependent care benefits. Tax benefits are available for expenses related to the care of dependents, such as a child or dependent adult, to allow taxpayers to work or look for work. Often takes form of a tax credit, which directly reduces your tax liability. There are a lot of tax deductions that are available, and you want to be able to take advantage of all of those. Some of the other ways of reducing your liability is to have the opportunity to take advantage of some of the tax credits. The tax credits that are out there, for instance, 100% bonus depreciation. Those that have a business where you have assets and you have equipment and things like that, being able to qualify for deductions for depreciation. They say for 2025, it's being made permanent for qualified property placed in service after January 19th of 2025 and can be used on both new and used equipment. So if you're a sole proprietor and you have an office, or you're a C Corp or a partnership, or you have an outside office and you have office equipment, and you have computer equipment, and you have machinery equipment and things like that, you'll get the actual cost of that item itself, and you look for the depreciation schedule in the IRS to find out exactly at what rates you can depreciate those items. You can't make them up. There are schedules that let you know exactly, how long a computer lasts, and that's how many years you're able to depreciate it. So you divide it up in months, and this is how many, how much you get to depreciate for those particular items that you have purchased. And so using that as a deduction or a credit for your tax liability is very beneficial. I believe most companies out there are utilizing the depreciation schedules and taking depreciation instead of expensing the full amount. Expensing the full amount is going to really have a detrimental effect on your revenue. And not only that, when the IRS sees this, they're also going to see that this particular item should have been depreciated over time. So you can't just expense things just to lower your tax liability and think that it's going to be acceptable. The laws, the rules are set that you have to depreciate these items over a period of time. But it does create a benefit and lowers your tax expense. Section 179 expensing, the maximum deduction has increased to 2.5 million for 2025 with a phase-out threshold of 4 million for qualified equipment purchases. Qualified business income, QBI deduction. The 20% deduction for eligible pass-through businesses has been made permanent. Yay. Phase-out thresholds were also expanded with an added minimum deduction of $400 for those with at least $1,000 in qualified business income. So that's a new law that's there, and it's something that you can take advantage of. Research and experimental expenditures. Domestic R&E costs for 2024 and beyond are now immediately deductible instead of being amortized. That is a huge benefit to you and those that have been doing research or experimental spending money for experimental things. I notice a lot of new entrepreneurs are out there. They're creating, these AI tools. They're creating, a lot of other tools that are out there. The equipment, the research, the expenses, instead of it being depreciated over time, you are now able to immediately deduct all of it instead of amortizing. Amortization is just like depreciation. It has a set period of time that you can expense it off, but now you are able to expense your research and development and experimental things. Um, you can deduct that. So keep track of those expenses, keep track of that time that's being spent, and all these different things, because those are deductible expenses in full, and it will reduce your tax liability significantly. And so you want to take advantage of that. And it's something that you definitely want to do. Work opportunity tax credit. Businesses that hire employees from certain target groups, such as veterans or long term unemployed individuals, can receive a tax credit of up to $9,600 per qualified employee. So if you are an organization, a business, a company, a sole proprietorship, a partnership, whatever, and you are hiring people that have been unemployed for a long period of time, or they're veterans that have returned and they're looking for work, or someone that is disabled and they're looking for work, when you hire them, you not only you get an opportunity to deduct an extra $9,600 per qualified employee. So not only are you getting a good worker, but you are getting a tax benefit for that worker, and you're also helping to build up their life, giving them purpose, giving them opportunity to get back on their feet. So keep this in mind when you're thinking about hiring. If you haven't done it in 2025, 2026 is a new year. There are a lot of people that are unemployed at this time. If you're thinking about hiring and you're thinking about, even seniors are coming out of retirement and going back to work. If you're thinking about hiring someone, consider those that might be in one of these specific groups. And you will not only have a good worker, but you also have that tax benefit. So that's something to consider when you're thinking about lowering your taxable rate. Small business healthcare tax credit. Eligible small employers that pay at least 50% of the employees' health insurance premiums may qualify for a credit of up to 50% of those premiums. That's another benefit that's happening, and it's great if you're able to, if you're large enough, or you've come to the point where you are able to offer them health care, health benefits. You're able to deduct that expense and lower your taxable income for your organization, for your company, by providing health care for your employees and getting up to 50% of that premium deducted. A credit for employer provided child care. Now, that is a benefit that would really be great for a lot of people who want to work, but it's difficult for them to work because of the cost of childcare. A credit for employer provided childcare. A tax credit is available for businesses that provide childcare services for their employees. So you're going to get a credit, a deduction from your taxable income for providing payment, or providing services, or providing reimbursement or whatever for your employees' childcare. And a lot of single parents out there, it's very difficult for them, especially if they're not living near home, or they're not living near a friend or something like that, and they can't afford, because they're just now starting back to work, They can't afford the child care. So many of them are still at home. You may be doing small jobs, odd jobs, but not being able to actually get into a career or establish themselves because of the cost of childcare. So this would be a way of helping some of the people that are unemployed, that are wanting to come to work or needing to come to work or to meet qualifications uh, for their SNAP, and they need to be able to get childcare. If you're able to provide, you know, um, childcare services for them, or you're paying those premiums for them, or whatever, then that is a credit that gets deducted from your taxable income. Energy efficiency incentives. Businesses making eco friendly upgrades such as insulation or HVAC systems may qualify for credits extended by the Inflation Reduction Act. So if you're involved in energy efficiency in whatever manner, you're going to get a deduction for the type of business that you're in and the type of work that you are involved. And here are some other common deductible business expenses. Of course, we should know all of these, but I'm going to go through them just in case you aren't aware. So, your common business deductions, and most of them, if you're using a business software, they show up as an expense on your financial system. And most of those expenses are deductible on your taxes. But let's go through them to make sure you understand. Salaries and wages. The cost of paying your employees, including salaries, wages, bonuses, and benefits, is fully, completely deductible as an expense, lowering the profit, lowering the taxable income for your organization. Rent. Payments for business property, including office space, storage units, is 100% tax deductible. And even if you are leasing, you're leasing a building. Maybe you have a warehouse that you use and for the supply chain, and you have food or different items delivered, and it stays in that warehouse until it's actually picked up and delivered or sent out. Well, that lease or that rent, that is deductible. There are a lot of different types of rents that are out there. Check your business, find out if you are paying any rents for anything, and know that those are 100% deductible. Utilities, expenses for your electricity, your gas, your water, the internet, the phone, telecommunications are deductible, with deductions even for a home office space usage. So if you have an office at home, you're a sole proprietor, you're working from home, keep track of your utilities, keep track of all of those expenses that you're paying out, because they are deductible based on your square footage of your office space, not 100% if you are a sole proprietor and you have a home based office. Other than that, it's 100% deductible for other companies that are outside of the home and in a building or what office space or whatever. Insurance. Premiums for most types of business insurance, such as liability insurance, which is protecting against someone falling or protecting against, you have a consulting firm protecting against, you know, someone, maybe errors and omission, things like that. So these premiums are business insurance, such as liability, property, and professional insurance is 100% deductible. So don't be afraid to provide or get your insurances, or make sure that your business is covered from liabilities, covered from potential harm, covered from potential lawsuits. Make sure your business is protected by some type of liability insurance. Travel and meals, business travel uh, expenses are 100% deductible, while meals are generally 50% deductible. So, and then you really need to make sure you're keeping the receipts on those, because if you are audited, you're needing to prove that you did travel, you did spend meals, it was for you. You're not paying for your friends showing up along the beach, but you actually have a business travel where you conducted business. Document the type of business. And I'm not saying you can't go to the beach. You can have a meeting, you know, at the beach somewhere, at a resort somewhere, but you need to document what you discussed as business so that it does not end up getting reversed from your tax return. Marketing and advertising, costs for campaigns, flyers, sponsorships, and other promotional activities are fully deductible. So if you're hesitating in marketing or advertising, everyone's out there, they're shopping, but they're not maybe going into the brick and mortar so much anymore, but they are online. You need to make yourself available. You need to make yourself so that you're visible, and that might require some help from a company that provides marketing, digital advertising, um, so that your product can be seen, your product can appear in a very nice ways so that it actually attracts and draws that potential customer in, gives them that feeling that they have to have that particular product. And you got to keep in mind you're competing with millions now because everybody is online. So you need to make sure that you have your marketing and advertising. And if you're thinking about the cost, think about that cost is going to be deductible. And if that cost is bringing you business, it's worth the expense, and that expense is deductible, you really have been benefited a lot. Legal and professional fees, necessary fees for legal and accounting services are deductible, 100%. And if I never say anything else, I always will say you need to talk with a professional about legal issues and your accounting. Seek out those professional services if you do not have someone in your organization already hired, because their job is to make sure that you're protected, that you're meeting all of the rules and regulations, that you are in compliance with all the laws, especially in your accounting. You want to make sure you're compliant with all the regulatory requirements with GAAP, generally accepted accounting principles, that you're aware of any new laws that have come in to that will affect your business, affect your employees. So you want to have those services. You want to be able to have services that understand your industry, understand your business, understand your forecast, because you did a budget, right? They understand where you're going, and so they're going to advise you the best way possible. And also, there's a lot, because of maybe AI and different things, there's a lot of infringement that's taking place. You may want to have legal counsel there to advise you of how to protect your particular product, your particular advertising of your product, making sure that someone is not creating your product and outselling it and you're not aware of it. So you want to have that legal and professional services out there, but they are deductible 100%. Interest on your loans, interest paid on business loans or credit cards is deductible, subject to limits for certain businesses. So it's going to require some research as to what types of loans the interest is deductible, and what kind of cards, how these cards are being used. Is it a business cards only, solely? then it's not going to be a problem. But when you start mixing that card with a personal card, um, and I highly recommend that if you're going to be deducting the interest on those cards, you need to have a separate business credit card that is used only for business transactions and no other type of spending. Then you would be safe. Your home office deduction, for most using a dedicated home office, a deduction can be calculated using a simplified method by tracking actual expenses. And you're going to want, like I said, not only are you going to want those expenses that you're tracking, but you're going to want to have hard copies of that information just in case you do get audited. So one of the thing is changing your business entity can provide significant tax benefits, but it's equally crucial to understand future implications. Each structure has its pros and its cons, and what works for one business may not work for another. So all of these things that I've mentioned, and there's so much more. Like I said, there's so much more that's out there, and you need to talk with a tax professional. But you need to understand just because this company functions this way, it is not a one size fits all. There may be some idiosyncrasies that you are not aware of that you need to make yourself aware of, or your accountant needs to be aware of, specifically a tax accountant. Every accountant does not necessarily understand all of the tax laws because accounting is a profession where it has so many vast areas that you work in. You don't necessarily um, even have the opportunity to be involved in tax. So you have a tax department. Most companies do when, and that's the only thing they um, concentrate on is tax and making sure they can reduce the tax liability. They're constantly researching for new changes in the laws, looking for new benefits, new ways to be able to reduce the liability. So they're there constantly doing nothing but research. And like I say, there's hundreds and hundreds and hundreds of codes that are out there. And searching through them, understanding them is a totally different situation. So just because you go and read them, you might read them, but you don't understand how to use it because it's connected to other information that it is not so easily recognizable when you're reading that particular code. So I would definitely advise you to always be looking for a tax professional. I'm not trying to give you financial advice. What I'm trying to do is trigger your mind enough that you become curious to find out, am I getting the best that I need for my corporation, for my S Corp, for my partnership, for my LLC, for my sole proprietorship? Are the right questions being asked to see if I am taking advantage of all of the different codes that are out there? Like I said, there's so many other codes that are out there, but your tax accountant needs to be informed, needs to be on top of it, and what you need to do is maybe ask the question, am I getting all of the benefits that I can take at this time? If not, can you research and find out what other benefits are available to me? You know, the one thing I want to say, I'll say it now because I don't want to forget. I'm not trying to give you financial advice, but I'm trying to give you enough information to make you go and take a step. Like changing your legal entity status is a big decision and should not be based solely on tax considerations. It can impact your business in many ways, including liability, control, and ability to raise funds. You must consult a licensed advisor or tax professional before making such decisions. In fact, you should always be talking to a tax professional someone that is their background, who is very knowledgeable about all of the tax code and all of the benefits and all of the credits and all of the deductions and also all of the pros and cons and pitfalls. Because as I said, all of them differ. They're not the same. It's not a one size fits all. Every tax code out there does not apply to every business or organization. And so you need to know how they are divided, how they're broken down, so that your particular entity, however you set your organization up, you get the complete benefits for you at that particular status. But what would it look like if you changed from a sole proprietorship to an LLC? What would it look like if you uh, became a partnership and collaborated with someone else? What would it look like if you incorporated? If you're at the point or the size or your dreams to expand are at the point where you need to become a corporation, because maybe not making some of those decisions, not making those moves are taking far more from you than what you actually realize. And so I know tax isn't one a pretty conversation or is even something you want to hear about until April, but it's something that you have to know about before then, because you have to prepare. You have to get the documentation. Some things, if you're changing entity, you've got to file to change that entity, and it takes a little while to get that filing done, and then to get the confirmation from the IRS that you have changed your status. If you're going to change your status, I would say you do it at the beginning of a year, not in the middle of the year, because now you've got two types of taxing entities there that you need to file, and it can end up causing confusion as to what you need to do and what you need to be breaking out and what kinds of things that you need to be concentrating on. So it's really important to think through this, and it's something you need to plan for. You just don't jump up and say, whoop, it's almost tax time. Let me go start doing all of these changes. No, you shouldn't, because you need to be thinking through. Yes, the tax liability might be high, but there's consequences in not doing it at the right time. This is why I'm emphasizing talk to a tax professional, find one in your area, meet with them, do research, and make sure that they really are, and their reputation is that they are successful in helping you to reduce your tax liability. Research, get references, talk to clients that they've had to make sure that they are legitimate, that there's someone that you can trust, there's someone that you can depend on their advice. But it is something that I would recommend that you consider um, looking at as you go into the beginning of 2026. You may be pretty late to be thinking about making some changes in 2025, but I will for 2025 look to see what particular deductions are permanent and you can take 100% and take advantage of those particular laws, because you are entitled for 2025. But for 2026, I think it's a good time to start thinking about, how can I stop leaving money on the table? How can I stop giving away so much money, you know, for taxes? Surely there is a benefit to me getting this business and keeping more money in my pocket. But talk with your tax professionals. Like I said, find one that is reputable in your area and that can sit down with you, and please do some research to make sure that the person handing you this business card has the references and the uh, professionalism and the ability to be able to look at your particular business. And one of the things I would always want to, caution you on, for those that you are thinking about looking for a tax professional, just like there's different industries, there are different types of tax professionals. If you are in manufacturing, you don't want someone who their customers are probably in the food industry, or they're in um, garment wear or different things like that. You're going to want someone who understands manufacturing, understands the manufacturing site, understands the plant, understands the equipment in the plant, understands the processes, understands the timing, understands, all of the different things and the different ways, the buybacks, and all of these different things. You're going to want someone who is informed in your particular industry. It may take a little while to research that, but I would research that. Just because they say they're a tax professional and does not mean they're going to understand everything, because they need to understand your business first. They need to understand your industry first. They need to understand your goals and, like I said, your forecast, where you're trying to go, because we're not dealing with what's in the past. We're dealing with what's going to be in the future. But since I said that, you may want to even have them look at opportunities. You have up to 5 years. You may want to have them check to see that you have received all of the benefits and they were on your preparation of your tax return. And so that you are not leaving money on the table. You may have an opportunity to do a revised return and be able to take care of benefits that were never considered in the previous filings and get that money back. So I'm saying this to just advise you to consider the professionalism of the tax consultant, but make sure they're in the industry that you work in, so that you're talking the same language when you are talking about your business and what your business is doing, and the kind of expenses your business has, and the kind of expenses you plan on incurring because you're expanding, or you've spent a lot of time doing research and experimental things on your new product, or whatever the things are. You're going to be prepared and understand exactly what's going on. So seek them out and look for them. I would just begin by looking for tax professionals. And then from there, I would start considering, um, then looking for, and tell them, I would like to have some references, so that you can actually contact those people. And then there's a lot of information out there in the data ozone. And you can get any one of those research tools out there, Gemini, ChatGPT. There's a lot of them out there. Get one of them and begin to research and find out. You can look, like I said, ask for a customer list of those they've done business with. If they're hesitant, you may want to keep moving, because if they've done business for them, they should have a reputation of being excellent. And if so, then it's someone that you want to be able to depend on, making sure you have the right um, tax setup, entity, and everything. I hope you've enjoyed the conversation. It's just sitting down, chatting with you, and just hopefully triggering your next step. And that is getting help, so that you are not paying as much as you have been, and you find out what these secret codes are that can benefit you. I thank you for joining A Sharp Outlook. We're here every Monday at 11 a.m. Eastern Time and 8 a.m. Pacific Time. I enjoy talking with you and sharing knowledge with you, and I hope you enjoy receiving it. Until next time, stay informed. I want to thank you for joining us on A Sharp Outlook. We have been informed and energized to take the next steps. We have posted links to websites and videos to learn more on today's topic. Please join us again next week for another thought-provoking conversation right here on K4 HD Radio and Talk 4 TV. Listen to the podcast on all the podcast apps. And until next week, stay informed.